Hey guys, and welcome back to Smart Money Minds. Buying and selling stocks often seems like a whole new world for us. It's full of financial terms and acronyms designed to pretty much confuse the heck out of us. In the market, every company has their own ticker, and this ticker is built with letters and numbers to represent that particular securities for that publicly traded company. So for example, Bank of America is BAC, while Boeing is BA, and Apple is AAPL. So once you figure out what company you want to buy into, you face a whole new set of categories of choices. In particular, these are order types and duration types. In today's video, I'm going to be going over the 5 key order types that you need to know, and also the 4 key duration types that almost every broker uses. Once you know these, you'll be able to buy and sell stocks like a pro. Before we even get into the order types, we're going to describe the marketplace a little bit here in terms of buying and selling. So imagine that there's a line of buyers and a line for sellers for a specific product like peanuts. Let's say the first person in the buy line is looking to buy 500 peanuts for $1 each, while the first person in the sell line is willing to sell 500 peanuts for $1.01 each. Until somebody gives up that 1 cent for peanuts, there's no transaction. Either the buyer has to increase his price to buy at $1.01, or the seller has to decrease their price and sell it at $1. Once the first transaction goes through, the next buyer and seller set up with a new higher and lower price. And so this is the nature of the market. So our first order is called the market order. Market order means that you're willing to buy whatever the price the seller wants, and you will take it right away. You skip the line and purchase those 500 peanuts in front of everyone else. So it does not guarantee that the price you're going to get it at, but it does guarantee you're going to get your peanuts. Say you want 1,000 peanuts, and the first 500 peanuts may be at $1.01, while the next 300 peanuts is at $1.02, and the next 200 peanuts after that is at $1.03. So your average cost of peanuts depends on the sellers. Our second type of order is called a limit order. Limit order is what the first buyer in line is waiting for. He's only willing to buy the peanuts for $1 or less. He's willing to wait and wait and wait until somebody fulfills that requirement with the right amount of peanuts. If he wanted 500 peanuts, he may only get 200 at that price, and if the price of peanuts never drop below $1, then he won't ever get all 500. So now, once you have your peanuts, it's time to know about your stop orders. Stop orders are there to protect you from your losses. Your third order type is called the stop order. A stop order means that if a stock drops below a certain price, then the broker will automatically sell all your shares for you. Back to our peanuts example. If you bought your peanuts for $1 and then you set your stop at 80 cents, then all your peanuts would be sold at 80 cents or lower if it drops to that price. This is similar to a market order. If you can only sell 200 peanuts at 80 cents and 300 peanuts at 70 cents, then that will happen. Guaranteed shares sold and guaranteed at 80 cents or lower. The fourth order type is called a stop limit order. This stop order includes a limit to the price. For example, if you set a stop limit order, you can set a stop price at 80 cents, while you can set the limit price at 75 cents. This means that your order will only sell between 75 cents and 80 cents. Unlike the previous example, if you sold 200 peanuts at 80 cents, and the remaining peanuts will not sell at 70 cents unless the price returns between 75 cents and 80 cents. The danger of a stop limit order is that your stop may not trigger if there are no buyers between your stop limit prices. For example, 75 cents to 80 cents. If there's only somebody willing to buy at 70 cents, it will skip your stop entirely. Thus, you might get in a lot more trouble if the stock price goes lower and lower. Also, in the Canadian market, you are only allowed to use stop limit orders instead of a stop order. So that is a limitation for trading in the Canadian market as well. Last but not least, we have the fifth order type, which is called a trailing stop order. This special type of stop loss is much more fluid and allows you to set a amount of dollar or a percentage of loss that you're willing to take. For example, if you made your peanuts purchase at $1 and you put 20 cents in your trail, that means you're willing to lose up to 20 cents per peanut on your trade, effectively meaning that your stop is at 80 cents. However, if the price of peanuts moves up to $1.50, then your stop is moved up as well to $1.30, as your stop will always be 20 cents below the highest price. This is an effective tool if you don't want to sell your position and you're expecting the price to continue to move up. A trailing stop allows you to not have to worry about the price dropping significantly and you making a losing trade instead. Now that we're over all the orders, let's take a look at the duration, which is the next category you have to look at. The duration is the amount of time we give for our orders to fill. The first one we're looking at is called the day order. That means that your order is good until the trading day ends at 4 p.m. Eastern Time. If it is not filled by then, it is automatically canceled. The next one we have is GTC, which means good till canceled. The order means that you have to manually cancel the order or else the order will be there forever. GTD means good till date. And you see that you can set the date in this order here. The order is active until the end of the trading day of that date. And lastly, we have GTEM, G-T-E-M, which means good till extended market. The regular trading day is from 9:30 to 4 p.m. Eastern Time. However, there is a pre-market and a after-hours market from 4 a.m. to 9:30 a.m. and from 4 p.m. to 8 p.m. respectively. Usually only major exchanges like the New York Stock Exchange or the NASDAQ will have extended market, and the pace is much slower with much lower liquidity. If your order is good till extended market, that means that the order will include the extended hours time, while a day order will not. This GTEM order will auto-cancel at 8 p.m. Eastern Time. So with all this information in mind, you're well on your way to buying and selling stocks. Make sure you comment below if you have a specific question and I'll be happy to answer. But if you like this video, make sure you hit the like button, subscribe to my channel, and we'll see you guys next time.